With the Fed beginning to cut rates, small caps have come back into focus for many investors. When it comes to the space, we believe it's not about chasing the latest macro event, it's about understanding what truly drives long-term value. Let's dive into this. Small caps are what I call longer duration assets, because much of their value comes from growth and cash flow expected further out in the future. As these companies focus on expanding their business and market share, changes in interest rates can have a bigger impact on how the market values them. Small growth stocks have previously outperformed when comparing the Russell 2000 growth to the S&P 500 during the falling rate environment from late 2018 to early 2021, and underperformed as rates rose beginning in the 2021 period. But as I often say, it's not just about rates. It's also about the fundamentals and the opportunity set. Historically, small cap growth stocks trade at a premium valuation relative to large cap stocks. That makes sense because they typically grow faster. Small and mid cap stocks are projected to post faster earnings growth than large caps over the next 2 years. We also believe they may be well positioned to outperform as monetary policy eases, relative fundamentals improve, and PE stands at historically attractive valuations. Regardless of market gyrations, in our view, there's always opportunity for alpha generation because so many companies are under the radar or undiscovered. An important characteristic of small caps is that we believe they're a very inefficient space. This is driven in part by the fact that there are far fewer analysts covering small cap stocks, and as a result it's easier to develop differentiated views. Differentiated views and greater inefficiencies provide active managers with the potential to create more alpha in small caps as compared to large caps. At Alger, we're benchmark agnostic. We are stock pickers and we generally don't own household names in our small cap portfolios. Therefore, our portfolios serve as a great diversifier for our clients in our view. We believe one of the opportunities today is small cap growth stocks are trading at a meaningful discount to large caps, levels we haven't seen since the early 2000s. We believe that the combination of discounted valuations and strong fundamentals creates potential opportunities. To find the opportunities, we invest in exceptional small companies undergoing positive dynamic change, businesses with the potential to become successful large companies. And we define size in terms of revenue, not market cap, because we believe that revenue is a better indication of size. We look for companies that can compound over the long term. Our goal is to identify companies that also have attractive business models, durable revenue streams, and strong balance sheets. Small cap investing also requires an unusual mindset of patience. Small companies do not grow in a straight line. Our job is to differentiate bumps in the road from permanent impairment of fundamentals. I always use the analogy of motorboat versus sailboat. In a slowing economy, sailboats need strong economic winds to grow. But motorboats, the companies we look for, have idiosyncratic drivers and engines that propel them forward, regardless of the macro environment. So, while small caps may be relatively more sensitive to interest rates in the short term, we believe innovation is a key driver of long-term value creation. With headwinds turning into tailwinds, we see a compelling stock pickers market in small caps, and we remain optimistic about what's ahead.